Hello everyone, welcome back. In our previous lecture, we have covered efficiency measures. During this lecture, we are covering liquidity measures. In general, liquidity means ability of the business to cover its current liabilities with current assets. Probably we all know about current assets and current liabilities. Current assets are assets which can be easily converted into cash, and current liabilities are the short-term liabilities which are usually needed to be repaid within 1 year. The liquidity of a firm is measured by its ability to satisfy its short-term obligations or short-term liabilities. Liquidity also refers to a company's ability to pay its outstanding obligations in the short term. For example, a bank loan which is needed to be repaid within 6 months is a current liability. If the company has enough current assets to pay the bank loan, we can say that the company is liquid enough to pay its short-term obligations. We can also measure liquidity with the help of net working capital, which is simply the difference between current assets and current liabilities. So, net working capital is equal to current assets minus current liabilities. If net working capital is positive, we can say that the business has enough current assets to cover its current liabilities. One of the most popular measurement of liquidity is current ratio. This ratio measures the current assets available to cover 1 unit of current liabilities. So the current ratio is equal to current assets minus current liabilities. Normally, current ratio of 2 is treated as a minimum desirable standard because all current assets cannot be easily or quickly converted into cash. For example, inventories cannot be converted into cash easily or quickly because inventory conversion into cash is quite uncertain. Quick ratio excludes inventories in the measurement of liquidity of the business, and inventories are the least liquid current assets among all current assets. So quick ratio is a better measurement of liquidity, and it is better than current ratio because it excludes inventories. Quick ratio is equal to current assets minus inventory divided by current liabilities. And the minimum desirable quick ratio is normally 1 or higher than 1. Cash ratio is simply cash divided by current liabilities. A high current or quick ratio do not indicate that the business is problem free or business does not have any liquidity any financial problem, because high current ratio or quick ratio also indicates that the company is holding too much cash and current assets, and the company is not investing its resources properly to create more profit for the shareholders. So keep in mind that high current ratio, quick ratio, or cash ratio do not mean that the company is problem free. Let's compare the current ratio, quick ratio, and cash ratio between two hypothetical organizations, ABC Incorporation and XYZ Incorporation. If we look at the current ratio, XYZ Incorporation's current ratios values in both years is higher than ABC Incorporation. Same is true for quick ratio and cash ratio. So it indicates that ABC Incorporation has liquidity problem. So the company needs to take steps to increase its current assets and minimize its current liabilities. If you look at the results individually, we'll also say that current ratio of ABC Corporation in both years is less than 1, whereas the standard normally it is considered 2 is the standard. Same is true for quick ratio, which is also less than 1, even almost equal to 0.5, and cash ratio is extremely poor. That's all about this lecture. In our next lecture, we'll cover market value measures.